Hi everyone, this is Dr. Saima Malik. Today I'm going to be covering the foundation of financial reporting, the generally accepted accounting principles, or GAAP. These principles define how financial information should be recorded and presented to ensure accuracy, consistency, and trust. The goal of accounting is to make information useful for the decision makers. Useful information must be relevant and faithful. Relevant information means that it's going to be influencing the economical decision making of the users, and faithful representation means that it's completed and unbiased. Accounting is not just about the numbers. Ethics guide us to do what's right, to report truthfully even when pressure exists to show better results. GAAP stands for Generally Accepted Accounting Principles. It's a set of rules and guidelines that accountants should follow when presenting and preparing the financial statements. It ensures the financial reports are consistent across different companies so investors can compare a firm like Apple to one like Microsoft on the same basis. There are the 10 foundational principles of GAAP that guide how transactions are recorded and reported. So the first one is regularity. Accountants must follow established rules and standards. For example, when preparing income statements, a company must follow FASB rules. It cannot invent its own reporting methods. The number second is consistency. Use the same accounting method over time. If a business uses a straight line depreciation this year, it should use the same next year unless a justified change is disclosed. Sincerity presents a true and fair financial picture. If a company expects a loss, it should record it rather than delay recognition to make performance look better. Permanence of methods. Maintain consistency among the reporting formats. For example, if assets are listed by liquidity this year, keep the same order next year as well. Next is non-compensation. Report all the positives and negatives without offsetting. You cannot hide an expense by netting it against the revenue. Each must be reported separately. Prudence. Don't overestimate income or underestimate expense. Record only actual income, not expected income. Be conservative with uncertain figures. Continuity. Assume that business is going to be ongoing and continually operating. When valuing the assets, assume that business will keep running, not going to be liquidated. Periodicity. Divide activities into specific accounting periods. Financial results are reported quarterly or annually, not whenever convenient. Full disclosure. Reveal all information which is relevant. If there is a pending lawsuit, it must be reported in the notes, even if it's not settled. So it should be materiality. It should be like the report information that could affect the decision making. A $5 error in a 10 million company is not material, but a 1 million misstatement is going to be. So the next concept is the difference between the GAAP versus the IFRS. Let's compare both standards. The International Financial Reporting Standards. GAAP is mainly used in United States of America, while IFRS is used in over 140 countries. GAAP is more rule-based. It gives specific steps for treatment. IFRS, on the other hand side, is a principle-based. It allows more professional judgment. For instance, under US GAAP, inventory valuation allows the LIFO method, last in, first out, but IFRS does not. That is the major difference. Why is Gap important? It's the backbone of reliable financial information. It ensures investors, creditors, and regulators trust financial report. It prevent manipulation and fraud. It allows analysts to compare companies fairly. If every company followed its own accounting principles and rules, investor would have no idea who is profitable and who is not. US GAAP basically provides structure and ethics to the financial reporting. It ensures accuracy, comparability, and transparency under US GAAP. It is essential for every accounting professional. It's language of business integrity. Next time you will look at the company's annual report, remember behind every number, GAAP ensures that it is fair, consistent, and comparable. Thank you.